bottom of your screen, that also is moving higher. So a lot of these stocks doing well right now.
Well, incidentally, PC Jewelers is also up 6%, though, of course, watch out. You had Mr. Tilson speak about it. Okay, with this backdrop of a market looking to break its near-term resistances, let's invite our market master for the morning, Krishna Kumar, CIO Equities at Sundaram Mutual Fund, joins us. Good morning, Krishna. Always a pleasure having you with us. There are a bunch of reasons why the markets are in strong hands. There is the global tailwind. Shorts have been covered. Do you think the market has legs to run more now, or will resistances come in?
It's $1 million question, to call the short-term trend in the market. Clearly, as you mentioned, there have been a lot of positive developments, in terms of global issues like the Iran sanctions. There's been some signing of peace between the Koreans. There's been also a fair bit of swing in terms of the mind share on Karnataka. More positive. So these are a few things which have come, and more fundamentally the earnings season has done extremely well in the first month. We've had a lot more positive takeaways from the results, and except the usual suspects, the corporate lenders, we have seen otherwise a very nice and rising earnings trajectory across various sectors in the economy. So this, along with going into the monsoon season, where the predictions are things to be normal, I think we probably have a lot of tailwinds at this point in time, with double-digit earnings growth into the next 24 months. So this is where I think fundamentally the market looks good from a medium to long-term perspective. However, some of these macro things we mentioned and the election issues could again move the other way and create some volatility in the next 15 to 30 days, which is something which we can't rule out.
Okay. Krishna, hi, good morning. I wanted to take that monsoon theme forward because, you do have a lot of these rural-focused stocks in your portfolio, whether it's, names like M&M Finance, a lot of these NBFC, Mandalam have been doing quite well. What do you see as the growth story here? Have we peaked out in terms of growth, or do you think it's still nascent in the cycle?
I think the rural economy is just coming back, into an upswing after 3-4 years. Last 6 to 8 months, we have seen some of the initial green shoots of recovery in demand on the FMCG side. There's been some more of pickup on the tractor side for some time. Two-wheelers, again, the sales are pretty much larger growth in terms of rural areas than urban. Look at the car sales again. It's not the metros that are selling well, but it's the semi-urban and other tier 3, tier 4 markets in FY18. So there are a lot of positive developments there, and we think that the 16-17 crore households which are in rural India are getting to benefit from a host of measures the government has taken to improve the agriculture income, improve other sources of income like the MNREGA programs targeted toward wages, improve jobs on construction sites, and also create a lot more connectivity and networks. So all these have a positive rub-off, and this actually will drive the consumption story in India over the next 10 years. So we are very, very clear that the rural thematic is a kind of a decadal story and a very, very close, similar to what we saw in urban India in the last 15 years in terms of the drivers of consumption and demand for various articles.
Okay. Actually, we must take this point on board very strongly. We missed a very important headline in all the papers today. Today, all Indian villages are electrified. Yeah. This is something that doesn't mean all households are electrified, because there is still the affordability and the last mile. But this is not small when it comes to the amount of rural push it can give, and generally that it can improve in terms of productivity. It's a huge macro for the economy itself.
Oh yes, it is, and of course, my eye is just on 2 or 3 stocks. Just see in PC Jeweler intraday, it went up 15%, and then all of a sudden someone just came in and sold it. So if we have tick by tick, from 15 it's down to now 11. Interesting, that one. But Krishna, good morning. The space which is really running away right now is mid-cap IT and also mid-cap pharma. Your thoughts on how to approach these two names?
Mid-cap IT is, one space where the performance actually had been pretty good, because on many of these small projects on digital transformation, the initial pilots, etc., these guys were able to kind of compete and take a lot of business share. At this point in time, the momentum has changed into a large ticket deals on digital and digital transformation. So the biggies are actually coming back into the fray and taking a lot of projects, as we have seen in the con calls of TCS and Infosys and others. The percentage of revenues coming from digital is going up quite sharply and growing at about 30-40% per annum. So, mindless of that, I think still the IT small mid caps are also growing well and getting into more niches basically. So at this point in time, we are a little circumspect in terms of the mid cap names from from valuation perspective. I think you had all the good things playing out in terms of growth, in terms of the currency, which is down about 5% this year, CYTD. So I think a lot of positives are kind of pricing themselves in, and they are getting near into an expensive zone. So that's the view on mid cap IT. We are selective there. On mid cap pharma, or generally pharma, I think we've always been very selective about the stories, playing niches rather than playing the generic story. We find that the time consolidation gives a lot more comfort to a lot of investors at this point in time, and could be a big contra if one has the patience of 2 years. Having said that, I would still wait for some more, signs in terms of, their ability to get into more generic opportunities, get their plans cleared, and have a good, kind of pipeline ahead of them, which is a little murky at this point in time. So we remain quite cautious there, and are playing the niche plays that you might find in our portfolios.
Okay. Well, Krishna, I want to inform you and all the viewers that what I was saying in terms of an ease of investment by FPIs looks like a very big thing that has been announced by the Reserve Bank on Friday night, that not only can foreign investors now invest in with lesser restrictions. They had to invest only in paper with 3 years residual maturity. Now they can invest in all kinds of paper. Even the stock-wise limits used to be 20%. Now they can go up to 30%. Whenever the extra limit came into the market, it was auctioned. Now it's not going to be auctioned. There are online monitoring. So, the premium that they had to pay to get that extra limit is not there. There is a lot of procedural easing. There is a lot of category-wise easing. And what bond dealers have messaged me is that if the markets were open today, yields would have fallen by anything between 30 and 40 basis points. That's a huge positive. Unfortunately, we don't have a bond market to react to it today, and we won't get it till May 2nd. But we are actually probably going to stare at bond yields something at like 7.3 or 7.35 instead of the 7.65 or 7.7 that it was ruling when markets went to bed on Friday. So it's quite a big jump given to the bond markets, and that is why you're seeing banking stocks so strong, especially a stock like SBI, which of course has so much of excess SLR and therefore will be the biggest beneficiary of any such easing of rules, and therefore rise in bond prices. A double positive for housing finance companies because they can also raise ECBs, and the wholesale finance also will go down. Krishna, I want you to react to this. They can raise ECBs, housing finance companies as well. End-use restrictions have been much smaller now. There is only a small negative list. And plus, I think, a bond rally, which the market can register only on Wednesday.
So I think, the government and the RBI are very, very proactive. If you look at the host of measures that the Ministry of Finance and the RBI have been going through the last 6 months. Very clearly, the regulator also understands the kind of capital flows needed for the growth in the country. We also understand clearly the kind of the liquidity situation with the banks and the capital situation. So we need a lot of foreign capital, be it debt or equity, to further the next leg of growth, and this has to come through at a reasonable cost to the company. So with this and also the fact that we need to manage our the deficits and keep the currency in check and the inflation also fairly controlled, I think the wholesome set of policies that both the government and the RBI are kind of going into. So I think it is very positive. While some of the risks to inflation etc. could still make yields tend to push up, but I think this is a very strong measure. Like you mentioned, the shorter end of the market will also go down pretty sharply, I think more than the longer end of the market, and this basically would mean a lot of companies also are able to raise capital again at more competitive market rates, so would benefit a lot of the NBFCs too as we go ahead from even local markets.
Yes, in fact, Repco Home is the big gainer now. 5% higher is what we have on Repco Home Finance now. Yeah. So that theme, Lata, as you pointed out, is playing out in some of these names, the housing finance in particular.
Quite clearly today, banking and finance is responding to RBI. Yeah. If the cost of money falls so much, it's going to be an immediate positive for finance, especially housing finance companies.
Okay. Well, for now, the space to be in is definitely IT. All the large cap IT stocks are the big nifty gainers. HCL Tech is up almost about 3% odd. Krishna, before we let you go, just a quick word from your end on some of the cement names, because you have been very bullish on names like Ramco Cement, JK, etc. Shree Cement came out with a decent set of numbers. More to go here?
Yeah, I think the cement story is kind of yet to pan out from a fundamental perspective. I think initial checks with the cement community and the dealerships indicate that a lot of them are sold out for the first quarter in terms of capacities, more so in the southwest regions, etc., and also on the eastern side. So I think it's a very, very healthy start to the year. All the the big improvement in order books and execution of companies on the construction and the road sector and the other infra projects, etc., clearly indicate that the cement demand would be able to grow double digit into the next 24 months. So this would give enormous pricing pressure and pricing power, and also operating leverage to the cement companies, which would go a long way in driving these companies in terms of their own returns to the investors. So we remain quite positive in terms of the cement story, and we do believe that earnings will be driving the stocks rather than valuations. Valuations already have caught up significantly, so it's now the time of earnings to move the stocks.
Okay, Krishna. Thanks a lot for your time today. It was good talking to you. By the way, I think we should have spoken about it earlier as well. Just look at the intraday chart on a Dish TV as well. That's also one stock where you're seeing a lot of short covering. Ahead of Reliance's numbers, the big talk in the market was that perhaps Reliance is going to launch that that TTH, and that too at much lower prices, and from 82, 83 it had corrected to 74, which is where of course the buyback price is also for Dish TV.